Great. So there's a few more people still joining, but just in the interest of time, I suggest we just kick off, and we might get a few more join in the next 5 minutes or so. So thank you everyone for joining, and welcome to our webinar with Grant Thornton. Today we're going to cover a variety of topics around the state of US trade policy and tax and compliance implications around tariffs, and the impact of global supply chain on global supply chain. So we've got the team from Grant Thornton here today to share their expert insights and talk us through the macro environment. So I will shortly hand over to Dan, who's going to kick things off for us. But I will just say the format of today will be a presentation followed by a Q&A. So if you have any questions, there's two ways to ask them. One is at the end. Do feel free to turn your camera on and ask directly. Equally, if you'd rather that I ask the questions, then please do just type them in the chat. And at the end, I will be asking a few questions and moderating a Q&A if we have any questions. So without further ado, I will pass on to Dan.
Thanks, Sophie. And yeah, it's great to be here. I think you're part of a great organisation, the British Growth Fund, and the investments they put into you as portfolio companies. I'm an international tax partner in Grant Thornton UK. I actually act on tax for a couple of portfolio companies, and as you might know, we act for quite a few across the piece. So it's great to be here. Who's with us today? From the UK firm, you got myself. You have Adam, who's Customs and Tariffs lead in the UK. He'll come on in a bit. Rachel Parker as well, who leads part of the relationship with the British Growth Fund. She's on as well. She won't be speaking necessarily, but she's around and listening in because it's very important to her, the relationship with the wider organisation. And I'm really pleased to be joined by Colin and Storm from the US firm, our sister firm in the US, Grant Thornton. I call them Grant Thornton US. I forget the formal names these days. But Colin and Storm have joined us to talk, give you the most up-to-date position on some of the changes, because obviously, as you've all seen, it's very fast-moving. Things change daily. I have days and calls with clients where I have to check the news in between calls to make sure nothing's changed from what I was planning to say in the morning. So you'll get the latest update from Storm and Colin on that. I put this first slide together. That's why there's inconsistent backgrounds and circles on the pictures, so forgive me for that. What are we going to cover today? We're going to start with the state of US trade policy. So like I said, what are the recent developments in trade agreements, some of the bilateral tensions, and what we're going to see in terms of dates and next steps, kind of a general overview. We'll then delve into a bit more detail on tariffs, so sectors and specifically on the UK US position. You're obviously seeing lots of news around discussions between the UK and US. Adam's then going to pick up and do a bit of a deeper dive for a few minutes on customs compliance, and then we'll talk about the overlap with transfer pricing. I'll talk a little bit about global supply chain impact and actually some surveys and things we've done with CFOs. We did one recently of 300 CFOs and just hear how they're responding to some of the tariff changes and then some US tax policy. And then we're going to finish, not to, I haven't put it at the end to reduce its importance, because I think this is terribly important, the one big beautiful bill and some of the tax implications that will affect you as businesses should the bill go through in the current format and with your arrangements with the US. I think tariffs tends to dominate the news headlines, but actually this part of US, the wider US policy outlook, is just as important, and for some businesses will be more important than tariffs as well. So I hope that sounds like a good session. We'll leave plenty of time for questions, hopefully. I think the session's being recorded. You'll get the slides afterwards as well. You'll see why that might be necessary when Storm and I try and go through some examples at the end. You might have to look at that those in your own time as well, but we'll send those around, and thanks for the opportunity to do that. So without further ado, I introduce our US colleagues. Colin was going to pick up this bit. Storm, I think you might be still having technical difficulties.
Colin, who's on my team, seems to be having some technical issues, so I'm going to talk about tariffs, although he's been our lead. This is not something that we normally had expertise in and talked about a lot until this year. But obviously, with the new Trump administration in place, tariffs have become a dominating topic in international business and international trade. So I just wanted to talk through a couple of the different types of tariffs that are in place, because I think it's important to understand the different authorities with which the administration is implementing these different tariffs, and why some of them are more perhaps legal than others. The ones that are being the most challenged are the ones here at the top, these IEEPA tariffs. So these are being done under an authority that the president has for emergency use. And so people have challenged these, saying that the emergency that has been cited for these tariffs is not legitimate for the countries that they are being put on. So the emergency that they cited was the fentanyl crisis, fentanyl coming over the borders, and that was how they put in these tariffs on Canada, Mexico, China, and then 84 other countries. And while the fentanyl issue might be legitimate for a couple of these countries, it was arguable whether or not that was an appropriate use of emergency powers for every country in the world. So that is currently undergoing legal challenges and is probably almost certainly going to end up in the Supreme Court being decided. But right now, the use of them has been stayed, so they are able to continue, but they have been paused after they were rolled out initially. Then you've got Section 232 tariffs, which are the ones that are being used for steel and aluminum, autos, auto parts, and then there are some ongoing investigations under this same tariff authority where they're looking at pharma, copper, timber, lumber, semiconductors, rare earth minerals, with the thinking that once those investigations are done, if they've produced the finding that the tariffs are legitimate here, that they would then move forward with those. And we'll talk specifically on the next slide about where things stand with the UK. Section 301 tariffs were more traditional tariffs, and these were used a lot more in the first Trump administration, focused around shipbuilding. Biden administration used these as well. But just to understand that why there are different lawsuits, different challenges being placed on these is because many of these are being done under different types of laws and different types of authorities. And it is a little challenging to keep them all straight. What is in effect, what is being challenged, what is going forward. So we have, like I said, those initial tariffs that were put on and then immediately paused. And now all these negotiations going on with countries across the globe to try and work those tariffs down. One of the things that has been challenging for everyone to figure out is there's sort of these contrary purposes that were stated for the tariffs. So one is we're putting these tariffs in place because we want to build up US production capability. The other is we want to raise money. But if you want to raise money, then negotiating all these tariffs back down dilutes that. And negotiating them back down, though, may help with the US manufacturing piece of it. So the administration can be a bit confusing when it talks about how much money it's going to raise from tariffs, but at the same time talks about negotiating with every country and bringing these tariffs back down to the point where they would not then raise that kind of money. And so I think the next slide, I'm going to hand over to Adam to talk about some of the UK specific status.
Yeah, thank you, Storm. Afternoon, everyone. So initially, we'll start with just the latest position, really, and obviously we saw, probably a month ago now, a fairly hectic week for Mr. Starmer with India, EU, US trade deals all kind of negotiated fairly quickly. I think we need to be careful with our language in terms of agreements or deals or any degree of formality to lots of these things.
Framework.
There's certainly, I think the term used was historic and comprehensive, and far be it from me to suggest Mr. Trump can employ hyperbole at sometimes, but I didn't necessarily agree with those definitions of the agreement with the UK. But what it's given us actually is it's embedded those 10% universal tariffs almost across the entire range of UK exports to the US. There's a list of exemptions and there's a list of variables. So I think the aluminium and steel tariffs, we got to a position where we were going to agree at 25, but I'm not sure that part of the agreement has yet been ratified. There's certain exemptions, which I'll talk about in a bit more detail. But things that are generally exempted currently tend to be focused or tend to be facing some degree of investigation in the short to medium term anyway. So I'd say that's a pause in hostilities on those things rather than a complete ceasefire. And obviously the headline one at the time was the autos and auto parts vehicle exports to the US, particularly finished cars. A real big thing for Mr. Trump, as we know, is protecting the auto industry and trying to reshore some of that. What the UK agreed was a 10% tariff on the first 100,000 cars from the UK to the US, and that pretty much covers UK exports annually to the US. And this is maybe why I say this wasn't such a historic and comprehensive deal, is because that now means, including the 2.5% is due anyway, that means UK cars are subject to a 12.5% import tariff, which is 5 times what it was a month earlier. Historic and comprehensive is doing some heavy lifting. If we move on, what I'm going to go on to next is a bit of what I look for in terms of compliance, because interestingly, the things we look for in compliance from a customer's perspective are also the opportunities to mitigate some of these Trump tariffs. And when we talk about tariffs, really, we're talking about a tax applied to imports of physical imports of goods across a territory in its simplest terms. Export tariffs don't generally exist, or they're very, very rare. World Trade Organization rules don't generally allow them. And the World Trade Organization actually is quite interesting because all member states tend to apply the same basic customs laws. So it means I can help businesses that are exporting to the US or moving stuff from China to the UK or within the EU or wherever it is, because the same basic rules are the same. We'll have a quick delve into those, nothing too technical. And then cover transfer pricing in slightly more detail. But we'll talk about these 3 building blocks initially. And what I'm interested in from a customs perspective always is origin, valuation, and classification. As we know, Mr. Trump's tariffs are origin focused, as Storm said, which talk about different territories. And when we talk about origin, what we're talking about is not where something was shipped from, but where something last underwent significant processing or sufficient transformation, i.e. where it was made. If we move on to the next slide, please. So the origin thing is actually not just a case of, we kind of finished making that there, so it must be origin there. There are some quite detailed calculations potentially that need to be done to determine origin. For what we call primary products, it's quite straightforward. So if you raise cattle in the US, they're US cattle. Where we manufacture products, things get more interesting or more difficult. And there's 2 ways we can confer origin on things. And one is what we call a value basis. So we would look at the sales price of, and let's use a UK example. We'd look at the sales price of a UK product, and we'd look at how many of the constituent parts were non-UK origin, and we would have to reach or not exceed a certain percentage for those non-originating materials which ship to the US. That would make it a UK product. The other way we do this is what's called a change of tariff heading. And goods moving internationally all have what's called a commodity code. I'll look into that in a bit more detail in a minute, but in effect, it's a coding that drives the rules of import, duty rates, things like that. And if you manage to change the coding between the product you import to process and the product you export, that's also a pretty good indication that you've sufficiently transformed the item between import through processing to export. You probably confer the origin where that processing was done. If we could just go on to the next slide, please. Valuation. The WTO again says you've got to value goods for customs purposes 6 ways, and you've got to apply these hierarchically. And the methods again are common throughout all WTO members. About 95% is done at what we call transaction value, the price paid or payable when goods are sold. You know, vanilla kind of third-party transactions, all quite straightforward. Where things get more interesting is where we get to say methods 4 or 5. And you get to those by either not having a sale, which allows method 1, or having a sale, but your relationship between buyer and seller, a connected party transaction, affects the price. And that means you then look at other methods, and often methods 2 and 3 can be dismissed because those kind of supplies don't exist. You get to methods 4 and 5, and this is where we have worked with a lot of clients in terms of mitigation of tariffs in the US, because we're looking to ensure that everything needs to be included in a declared customs value is included, but we're not including things we don't need to include. And where we've really seen this hit UK businesses is where they've previously supplied 0 duty products to the US, and therefore the value they declared they didn't care less about because it was always a very round number that resulted from the calculation. And now suddenly someone's saying 10, 25, 50, 150, whatever the auction was that particular week, as Dan said, value became really quite important. So we've worked quite a lot with clients to try and mitigate the impact of those Trump tariffs by reducing the declared customs values. The other thing, the final thing we look at, and again, there's a Trump mitigation point here, is the classification of products. If we could just go to the next slide, please. Everything tangible, from the blood in your veins to my coffee cup, even to the dog sat just over there on the sofa, all has a commodity code. Everything is classifiable if it is a tangible good. It's classified in a thing called the tariff. And why we care about the commodity code of things in relation to Trump tariffs is because the exemptions that exist to Trump tariffs are commodity code specific. They list the commodity codes which the exemptions apply to. Some things are quite difficult to classify. And we have rules that must be applied called the general interpretive rules to classify all sorts of strange and interesting things. It drives things like duty rates, import licensing, quotas, rules of origin. The whole compliance piece is built around these 3 things. The only other thing really of interest is that we also have common tariff mitigation schemes internationally. So we have things like processing schemes. So in the US, you would call that a drawback scheme, an inward processing drawback scheme. In the UK, we'd do it as a suspension scheme. But all the same kind of reliefs exist in different territories. So it could be things like a customs bonded warehouse, where you can store goods indefinitely without triggering the duties. And again, that would exist in China. All these things are the same throughout internationally. It's quite interesting. Customs not only has those international commonality of rules and reliefs, it allows you kind of to think about things more strategically, because you know the kind of things that you'll be able to do in each territory where goods may be worked upon. I mean, the final thing just to note, and this is where I hand over to Dan, we talked about customs values, and we talked about potentially where there's a connected party transaction, things can get more interesting from a tariff and customs value perspective. You've also need to think about how that interacts with transfer pricing. Obviously, transfer pricing, the value you declare goods and services between connected companies. What you'll find is a customs value will rarely equal a transfer price. And that's where I stop talking about transfer prices, because I will be so far out of my depth, I'll probably sink out of view. And over to you, Dan.
Yeah, thanks, Adam. And and this is where Adam and I tend to work jointly on clients and thinking through these things, and actually some BGF backed clients as well, like I said at the start, working through all these issues and looking at it like putting up a piece of wallpaper. So there'll be a bubble pop up somewhere over here, you try and push it down and reduce the customs value, and actually another problem or opportunity pops up over here as another bubble. Transfer pricing is another bubble where actually tariff related risks should be factored into your transfer pricing analysis in the first place. So those of you who've done transfer pricing analysis, functions and risks are what transfer pricing is all about. Tariffs and customs are a risk that needs to be factored in. Transfer pricing does always have to accurately reflect the economic reality of the transaction, decision-making, responsibilities cross-border, and you can't just be one-sided and try and reduce your customs and tariffs implications and costs without worrying about transfer pricing. Not just from a numerical point of view that you're slightly changing your transfer pricing position. If you go too far in trying to change a position to help you from a customs and tariff perspective, you can sometimes change the characterization of an entity in a particular country, maybe from a bit of a distributor to a limited risk distributor, something like that. And actually that can give you all sorts of tax and transfer pricing problems as well. So the normal things that you'd worry about in terms of pricing, they always need to apply as part of customs and bring in teams that have got that combined expertise, I would say. So there's some things on the slides there, on the points there, that I think you can take away and have a look at. But the key takeaway is don't just do a one-sided customs analysis. I think no matter how good Adam is at it, you always need to bring in a friend as well. It's like customs. It's customs Christmas the last few years for Adam. You can tell, look, he's smiling. So I'm just going to do a few minutes on global supply chain impacts before going back to some of the wider US tax policy updates. And this is just some, starting with some insights we got from a survey recently. So this was just really focused on tariffs, the stuff that Adam and Storm have talked about so far. So what are we hearing? This was back in May. I can't remember the timing. I think this was after the first UK announcement. But forgive me if that's wrong, but we've done a couple of these. What are we hearing out in the market? It's a bit of it's probably the wrong way around for my brain, but the first point saying only 3% said the tariff landscape has not influenced their finance functions priorities. So if I flip that on its head, it's 97% of the respondents said that this landscape is influencing their finance functions priorities over the next 12 months, which I don't think is a surprise, but 97% is a very big number, isn't it? 28% of the survey respondents said that their internal teams lack either the tools, data, expertise, or capacity to model different strategies. Now, that was just around tariffs and customs. Actually, as you'll see when we come on to the next main section of the presentation, there's other things that you need to be modeling as well as just the tariffs and customs position. Only a quarter said that they're very confident in their current ability to manage customs issues. That means there's 3/4 who aren't confident. We know some people who could help with that. And 44% said that they lack the detailed knowledge of their supply chain to be able to contribute to this agenda. You know, some of the respondents mentioned from a sustainability perspective in other areas. Some of the CFOs that I've talked to, they're always confident that they understand their supply chain enough for their existing finance responsibilities, let's say. When something new like this comes in, which really, really relies on a deep understanding of the practical aspects of the supply chain, that's when we start to see survey responses like this, which I think is interesting. But it's not all bad news, negative news. This is the right way around for my brain. So 95% of the CFOs said that they foresee strategic opportunities emerging from the tariff landscape. That was the headline. When we've asked people what they meant by that, they talked about M&A, they talked about new markets, they talked about the next point as well, which is an opportunity to reshore or diversify your supply chain for competitive advantage. So I think that's really good that CFOs out there in the market are kind of getting used to this, you know, the last few years, decades of dealing with uncertainty and things being thrown at you, and actually, you know, taking a deep breath, saying, oh, okay, this sounds bad, I'm going to have to deal with it, but then turning it on its head, you know, with the right advice and input from other stakeholders and say, no, actually, this is an opportunity. It's not just a problem for us. And the last one as well, 48% seeing an opportunity to strategically take market share, whether that's through M&A or new markets. So I just thought those were interesting to share from the survey we did. What have we seen clients doing structurally? I mean, the first thing, Adam and I, and we joined some very early calls with Colin, with some clients in the UK, and they were not panicking. Like I said, CFOs and finance teams have got used to dealing with, issues coming at you from nowhere, but some concern about the position. And actually, when Colin and I and the rest of the US team talked through with one particular client that I remember, the passing on of costs from tariffs has become not more prevalent in discussions, but I think people have started to get more comfortable with it. So actually, part of that is looking at your competitor's position too. So the one client that Colin joined very early on the call was it's a UK business, but their main competitor was US. So on the face of it, you could look at that and think, oh dear, we're in trouble here. We've got a 10% tariff. The US competitor hasn't. But actually, from public information, you can piece together a bit about that US competitor's supply chain and actually see that a lot of the US competitor's components came from territories that are in a much worse place from a tariff perspective than the UK. So actually, you start to then think, well, maybe this is better for us, or at least worse, not as bad as we thought it was because of our competitor's position. Equally, if you're very confident that you've got good market share, quality product, all those sorts of things, in a way, why wouldn't you be able to pass on 10% or 5% of the cost and model that out? I think actually I can wear that for a while. So don't dismiss that. I don't think you have to do something super clever here. Actually, there's a market position that some of you would be in that it almost doesn't really matter, the increasing costs apart from the compliance. But we have seen some clients looking at changing their trading arrangements. I think Adam alluded to some of this. Some of the interesting conversations I've had recently are around things like maquiladora. Hopefully I'm not butchering the pronunciation, I normally do, but situations like that where you actually in the past you've not really cared about the customs and tariff position. You can just move things cross border and it doesn't really matter. Actually, I had one client discussion where they were producing a lot of things in Mexico. Parts were going from the US to Mexico and then back to the US for the finished products, but actually a large chunk of the finished products weren't meant for the US market. It's just they'd never had to deal with that point before, never really worried about it because there's no or very little tariff or barrier to trade. Now there is, with stuff coming from Mexico. We change those arrangements a bit. The things that aren't ultimately destined for the US market, Adam's going to tell me off for butchering this, but drop shipping it, something like that, right? And actually it doesn't really touch the US officially. So there's things like that you can do around the edge once you delve into the details of your position. So those are just some of the things we've seen from supply chain. Like I said, a lot of CFOs looking at, well, turning on its head and say, I've really been wanting to, there's reasons I want to look at my global supply chain. I want to nearshore, shorten things, change things, and maybe had some reasons to do it, but not enough from a cost benefit analysis perspective. But actually now in this environment, maybe it's an excuse and a reason to do those things that you always wanted to do, but they felt like there wasn't the right cost benefit for that. And the final point is modeling. Adam talked about it a little bit, and I talked about it with my wallpaper example, and just thinking about the wider issues that are going on as well, interrelated. Before we got into the US analysis, there's other things out there that are changing that can feel like tariffs as well. So the UK and the EU's going to be putting in place a carbon border adjustment mechanism for certain products. Those authorities are very keen on those not being seen as tariffs. They're being seen as environmental measures, not trade protection measures. However, the implication of them is increasing cost for imports of certain products into the EU and the UK. So there's wider things than just the US position going on. The US position gets all the news headlines, but there's other things you need to factor in depending on what industry you're in as well. So I mentioned the wider US tax policy changes. Those need to be modelled in and factored as well. And these changes could apply to a wider section of you on the call than the tariffs, because the tariffs apply to certain products. The US changes apply across all sectors, the tax policy changes should they come through. So before we get into a few examples that I'll try and pick up, Stormy just going to give us a bit of an update and latest on that.
Thanks, Dan. So the One Big Beautiful Bill Act is the massive piece of legislation that's currently working its way through Congress. And we're getting very close to the end, it would appear. The bill, which is, it contains a great deal of Republicans' domestic policy priorities, the White House and Republicans in the Congress who have the majority in both the House and the Senate. And because they hold the House, the Senate, and the White House all within the Republican Party, they're able to use this process, which you've probably heard about in recent years, where they don't need any support from the other side, and they're able to pass things with just a simple majority, using very narrow rules that they have to meet. This is how the Tax Cuts and Jobs Act was passed in 2017. This is how the last big Democratic tax bill was passed, the Inflation Reduction Act a few years ago, when one party holds all three of those majorities, or the majority in the House and the Senate, and they hold the White House. They're able to do things that they're not otherwise able to do. So Republicans are currently working on this bill that will not need any Democratic support, and so is very Republican focused. It passed the House back in May, and this is now working its way through the Senate. The House had hoped that the Senate would just pass exactly what the House passed, and we would be done and dusted, but the Senate wants to put its own fingerprints on it, and so they're working on their own version, which will then have to be passed again by the House before it can go to the president. There is a great deal of pressure on it to get to the president's desk for him to sign by the 4th of July. This is a president who likes symbolism, and the symbolism of being able to sign his big, beautiful bill on the 4th of July is very big for him. And so he's putting a great deal of pressure on this, even though there are still some really big hangups between the two chambers that they are frantically trying to work out this week. It sounds like they are going to stay in session over the weekend and into next week, if necessary, to get this to the president. And we're not exactly sure how some of these provisions are going to turn out. But I think generally the ones for our discussion today that are relevant are not in the middle of these big fights, other than one section. So the bill has similar provisions from the House and the Senate on some big business priorities that have been hanging out there for a few years. Return of 100% bonus depreciation on all business capital assets, domestic only R&E expensing. This is obviously different than going back to pre-TCJA times, where all R&E expensing or all R&E was able to be expensed rather than amortized. In this case, only domestic R&E will be able to be expensed. Foreign R&E will still have to be amortized over 15 years as passed as part of the Tax Cuts and Jobs Act. And then 100% bonus depreciation for qualified production property. This is a new provision that the House and the Senate have put in that is in both bills. Right now, the House and the Senate have different lifespans on this. The House has all of these provisions in for 5 years, starting this year. And the Senate has made all of them permanent. And so we're going to have to see cost-wise what's going to prevail, whether it's going to be one or the other or somewhere in between, because they're trying to figure out the dollars right now and whether or not they can afford to make all the things permanent that they would like to make permanent. Obviously, for businesses, permanent tax policy is much more preferable because of the stability that it provides and the assurances of having the tax code intact going forward and being able to do planning. But these are all going to be in there for some period of time, I would say for at least 5 years, if not longer. Where there are a few more significant differences, Section 899, which has been, of course, the big issue amongst the international set recently, and we'll talk a bit further about that. Changes to GILTI, FDII, and BEAT which are international tax rules that, of course, the US would argue that GILTI is our version of what should be considered a Pillar 2 compliant regime, but that has been deemed not to be. The Senate's version would get closer to a Pillar 2 type regime by raising our GILTI and FDII rates to 14%, and then with the haircut that's included would get us pretty close to that 15% Pillar 2 rate. And I believe, the Senate intentionally did that to try and give our Treasury Department a better argument at the OECD negotiating table to say, look, we're basically in compliance with Pillar 2. Now you really do need to grandfather our scheme in. So I believe that that's the thinking there, and everything I'm hearing from Congress is that the Senate's version of all these things is likely to prevail, generally speaking. So while they are different right now, it looks like the Senate will probably be the version that comes out of this. And then the timelines for clean energy provisions, that all these tax credits that were put in during the Biden administration for different types of clean energy. The Republicans are trying to terminate most of those, and the House had done it on a much more swift timeline. And the Senate is trying to give a bit more of a slower ramp down, and is getting a lot of pushback from the House. So we're not exactly sure where those timelines are going to end up. But if you are investing in any kind of clean energy products or clean energy projects in the U.S., it's going to be very important to look at the placed in service and the start of construction dates and where all those end up on the different types of tax credits there. Go on, please. So Section 899 is the piece that has really gotten so much attention because it is seen as, some of the Republicans have even called it a revenge tax. This is taking aim at what they call unfair foreign taxes, including a UTPR, digital services taxes, diverted profits taxes. All of those are specifically called out in the legislation. And it would introduce these increased taxes for companies that are from jurisdictions that have these types of taxes in place. As we note here, the UK has the full bingo card of UTPR, DSTs, and DPTs. So this would apply to all UK headquartered companies would be hit by these new taxes. It introduces this new regime. So on the one hand, you've got increased income taxes and withholding taxes. And then on the second, we have what is being called the super BEAT. So it's a BEAT plus. And what's important to note here is that if a company has not previously been subject to the BEAT and has been able to ignore our base erosion and anti-abuse tax in the past, don't think that you don't need to pay attention to this, because it gets rid of the revenue threshold that has kept some companies away out of the BEAT regime. And so companies that have previously never had to think about BEAT before could now be subject to this because the revenue threshold is gone. The Senate version, which is the version that seems like is the more likely to prevail, does take effect later than the House version, which is something that I think there was a big sigh of relief about. The House version would have gone into effect as quickly as the beginning of 2026. The Senate version would not go into effect until 2027. And so the argument that was made going into the Senate version was there are all these countries that are in the midst of negotiations. The US is trying to bring all these countries to the table to negotiate deals. There is no way that most jurisdictions can turn around legislation or their parliaments or whatever their system of government requires to necessarily get rid of a UTPR, a DST, a DPT, even if they want to, in the course of a few months, and be in compliant or get themselves out of this regime by the beginning of 2026. And so that delay at least gives countries the opportunity, if they choose to do something about those taxes that would then put them in these positions of being subject to the super beat and to the new withholding taxes.
And I think, and Storm, that point on the UK, on the legislation process, that would be right for the UK. So if the House version or the House dates were going to prevail, there's no chance the UK could repeal any legislation before 26, even if it wanted to. Like you said, for the UK, and we'll go into some examples here. We've got the full bingo card, so there's three. We've got all three of those things. I think it's only us in Australia. Australia normally follows what we do in tax avoidance legislation, and us in Australia have got all three things. So it will be politically necessary for the Labour government to potentially back away from some of those things, like a digital services tax that is politically attractive and sensitive. So interesting to see where that goes.
I will say that those three taxes are specifically called out in the legislation, but then there's also leeway for the Treasury Secretary to deem other taxes as unfair foreign taxes. So there's going to have to be some measure of caution around trying to say, get rid of your technically what is a DPT, but put something in place that is essentially a DPT, but isn't exactly called that. Like that can still fall under the Treasury Secretary's authority.
Yeah, it makes sense. Yeah, so there's still a lot of uncertainty, isn't there? So, so we thought we'd finish just to bring it to light, and we thought I would do this as a UK person that kind of knows these rules, just to kind of explain it to UK-based finance teams. Obviously, I'm not a US international tax person, but hopefully these examples just show you the impact. I had my US international tax colleagues put these together. I think towards the top left, you can see the box that I put in saying that the example we put together is for a larger business. So this is a business processing, made up business process outsourcing business that's got significant revenue in the US and passes the old BEAT threshold, which is $500 million of sales on the rolling average basis. As Storm said, Super BEAT, House or Senate version takes away that threshold. So any of you who've got any US sales, if these rules come in, you will have to do some BEAT analysis. I'm not saying you have extra tax to pay, but you will have to do some analysis on this. This is a larger example. What we have is private equity fund, private equity backed UK company at the top, US corporation, Indian service company. You can see the US position. They've got $1 billion of revenue. They've got 25 million of local operating costs in the US. They're paying arm's length 400 million to India, arm's length 50 million to the UK. Let's assume they're deductible for US normal federal tax position. You end up at 110 of US federal tax. Current rules, this business is within BEAT. Many of you will never have had to look at this second calculation. But how you calculate BEAT is effectively take your taxable income number from the top, and then you add back certain items that are seen as cross-border base eroding payments. So here, what's adding back is 40 million, which is the markup on the payment to India, not the gross amount, and is the 50 million royalty back to the UK. You have some modified taxable income. You applied the BEAT rate to that, and you get the 61 million number. If the BEAT number is higher than the federal corporate tax amount, you have to pay top-up tax effectively in the US.
Can I also chime in that the Senate bill also includes some significant changes to BEAT. So the BEAT rate, if this is to pass, is going up to 14%, and the calculation is changing slightly. So
that's right. Yeah.
So keep that in mind as well.
That's right. Yeah, and hopefully we put that into the next page correctly. You can check if I haven't. But what we're saying over on the right-hand side as well is that the intragroup payments under the Section 899 that Storm talked about, in the future, those intragroup payments could also potentially be subject to additional withholding taxes as well. So that's important to keep in mind. So how the calculation would work, and my US ITS team put this together. You can see the current state calculation on the left as you look at it. That's what we just had. Current state calculation, actually less than the federal corporate tax rate, no BEAT liability. Over on the right-hand side includes the changes that are going through the legislative process at the moment. I think if you go right to the bottom, let's say, just to really ram home the point, there's an extra 26 million of tax payable in the US under this made-up example. That is because of some of the changes in methodology that Storm talked about. You can see the payments to India included in the calculation are not the 40 million markup, it's the gross amount. And then the BEAT rate, Senate version 14%, House version 12.5%. So you end up with an extra 26 million to pay in this situation. Now, a business process outsourcing company with this situation is quite an extreme example, I would say, but there's plenty out there that will be similar profile to this. As I said, this is a big business, but Storm went through the taking away of the minimum size threshold means that effectively anyone will have to do this, run this analysis at least, and run some modelling. Have to run that modelling at the same time as maybe you're modelling impact of tariffs, and maybe you're modelling impact of transfer pricing changes, all those sorts of things. So it's something else that's going to have to be dealt with by everyone. And I've got a call with a client, UK listed client, straight after this. We're in the middle of some transfer pricing work between the UK and US, and actually we've got to change our modelling to include all of these things and assess some of the implications should the bill go through. So thanks to everyone for presenting today. That's been fantastic. As I said, we'll share these slides. You'll have the recording. We've got a few minutes left for any questions. I know we've squashed a lot in there, I think, but we thought it was worth, like I said, the original concept was to talk about tariffs and trade, very important, but we wanted to land the last part as well, which is another thing that's hopefully not coming in from 2026 now, but seems likely to be a 2027 thing, which will roll around pretty quickly as well. So Sophie, have you picked up any questions, or does anyone want to take the mic? What do we want to do?
Has anyone got any questions or would like to write them in the chat? I'll kick off while we're seeing if anyone has any other questions. I guess going back to sort of more of the tax piece, is there what should businesses' response be to these potential changes around tax? And is there a way to measure the impact and then think about how we might change position given those changes?
Yeah, I think I can't give a better answer than just to model the positions and put sensitivity analysis around it, and we can help you with that, obviously, and other advisors can help you with that if you don't feel like you've got the capability internally. But I think you just have to have some sort of model that you can toggle some of the changes. Helps if you've got long-term, medium-term forecasts for your business as well. So a pharmaceutical client I work with that's PE backed in UK business that's set up a structure into the US. They were never in BEAT, they are now. We set up the structure with royalty payments from the UK, sales of goods from the UK, a loan from the UK. They weren't in BEAT. Hopefully they will be one day, because that's a nice problem to have for the 500 million threshold. But that threshold won't even be there anymore. So the tax model we did for them, we're going to have to change it and update it to include some of this sensitivity. Lobbying, those sorts of things, that's Storm and Colin's bag historically. Some of the larger clients,
I think it's a bit late for that.
Yeah, some of the larger clients.
This is going to be done. This is going to be done very quickly, and has sort of reached the level of very, very senior leaders in the Congress negotiating the final details, sort of.
Yeah, because some of the larger listed businesses I've spoken to that rely on the US for dividend flows and profit reserve flows back to the UK, that could be impacted by the 899 withholding tax position, so increased withholding tax on dividends out of the US. Some of those groups I spoke to, they started off trying to lobby in the US. they gave up very quickly because they realised they weren't getting anywhere, and actually started talking to the UK authorities as part of the FTSE 100 tax group around the can't you get rid of the digital services tax or something like that, to try and, you know, admit the US legislation is going to go through, deal with the UK end. Businesses of the size we're talking to today are not part of those discussions, but hopefully they could benefit from them. But I think I go back to the modelling, right? You've just got to look at the sensitivity of this.
I do think lobbying did have an impact in the delay that the Senate put in of a year. I think there was a big outcry noting that it was just going to be it was going to be impossible for countries to do anything to change their situation if this went into effect as quickly as the House was going to have it. So there was some impact there.
That's good.
Great. Haven't had any questions coming yet, but just one more from me. I guess looking at sort of the deals market, do we think we might see an impact there, and from that perspective?
So, personal reflection, yes, I do. So, throughout my career, I've seen significant tax policy changes, especially in the US, drive transaction market activity. So, back in the day, towards the start of my career, you know, a lot of transactions looking at moving out of the US because of the US tax rates a long time ago, and drove actually redomestications, relistings. Like, tax policy does lead to those sorts of things. Here, I think there's a few angles to it. Possibly some of the larger PLCs, let's say, these rules come in and they're impacted by the increased dividend withholding tax. Might they rush to bring back reserves, E&P notwithstanding, bring back reserves, dividends from the US before the rules come into force, and then that gives them what they're going to do with that money, right? There's then a war chest in those places potentially to spend. If you look at a couple of my clients where they're predominantly US market, but UK headquartered, if some of these rules come in, then it makes their tax position significantly worse. For me, instinctively, that's a reason for PE funds to come along and say that's an extra value driver for us to acquire you and maybe change your headquarters, something like that. So I do think it will trigger lots of discussions, and it's one of those things that my corporate finance team at Grant Thornton in the UK, sometimes they're not very excited about tax. They just want us to say due diligence is fine or whatever. But actually, this is something that they are interested in because they can see that it might have those sorts of impacts. Don't know if Storm and Colin have got any extra insights on that as well.
I think there's a lot of uncertainty, and I've heard internally that that's held up some M&A activity for the first half of this year. There was a lot of excitement about M&A with the new administration coming in, new year. But because of the amount of uncertainty, both around tariffs and taxes right now, I think a lot of companies are holding off. I have heard anecdotally that companies are looking at some M&A for sort of the onshoring component to get around tariffs, basically to have a US supplier, or basically shift their supply chain in some way through a US acquisition in order to mitigate some of the impact from those tariffs. But right now, I think most people are just taking a wait and see approach. We've got that July 9th date coming up for a number of the tariffs that are on the table right now. The court process is playing out for these IEEPA tariffs too. That's going to take several months, and we will see when this mega bill around taxes largely, and a number of other domestic priorities, primarily domestic priorities, comes through, whether or not it's July 4th or closer to August, as Storm and I have both kind of been placing the odds on. So I think a lot of folks are just kind of holding off until they have more certainty around those major areas.
Great. Well, I don't think there's any further questions. So all that's left to say is thank you to Dan and Storm, Adam and Colin for joining us. That was a really insightful session. I'm sure if anyone thinks of any questions, they'd be happy to answer them offline. So please do drop me an email if anything else comes up. As Dan said at the beginning, I'll be popping the slides and the recording on Scale. For those of you that aren't on Scale, I can always send over a copy of the recording as well. Just let me know. Thank you so much for joining, everyone. And thank you to Grant Thornton, and have a nice evening.
No problem.
Thanks for having us, Sophie.
Thank you.
everyone. Goodbye.